Your wife is from there? I think Italy is also quite good. Salento area, Sicily, neighborhood, it's very, very close to Roma.
Tanz auf 3 Hochzeiten gleichzeitig.
Yes, yes, yes.
Okay. We use it as a magnet.
Okay, we're going to start in a couple of minutes. You want to start slowly taking your seats.
I went to New York for CBS 13 years and then baby there, so quite a year longer. So the idea is 3 years.
Oh yeah? Okay.
So my family is better, so I really okay, I like it. I just want to next time it's on my own.
Okay, it's half past.
As you know, I was looking at Australia from every direction. I'm excited. It's ready for Sunday. And then, after the years, that's exactly what I've done. For my age, I thought that in terms of social, it would be nice to be with the executive people. So I have kids, it's great. The full timers are really kids and so on. So it's also fine.
Okay, welcome everyone. Sorry. It's good to see so many of you looking fresh and relaxed from last night. So yeah, I really enjoyed yesterday the questions and thank you everybody for your participation. So this morning we're changing tack a little bit. So yesterday the idea was it was for the investors and an opportunity to talk about the fund and the investments. And today it's a different agenda. It's for the emerging managers. So as everybody knows, I think I work on my own, which means I don't have any apprentices or young people working for me who I can help. And so in order to assuage my conscience a little bit, I've made it part of my company's purpose to kind of help the next generation of fund managers to kind of get started. And I know a lot of you guys like to hear my story and how I got going. So that's the purpose of the session today. And it is also maybe a slightly selfish purpose that I very much have benefited as a fund manager through my network, and my network can only grow if young guys manage to get started as fund managers and hopefully become successful over time. And so that's also a big part of the reason why I organize this event. I heard of an echo. Is the sound okay? Unfortunately, we lost our guru.
Do we want to try
Maybe we should do it
without microphones or just project?
No,
If you can't hear us in the
I
back,
suggest that you switch off your microphone
No, I think there's a speaker there, which is.
or a speaker.
There's
Yeah,
a speaker there.
must be a matter of.
Without using my boot.
If one of the microphones.
yeah, so I'm on mute, see if that helps. Maybe try.
That's it. The problem is the sound. Okay. Let's try without the microphones, and if that doesn't work, then we'll have to figure out something else. So, hopefully you can all still hear me?
Yeah.
Okay, but please, if it gets too quiet, you have the sense you can't hear, tell me immediately. There's no point in doing this if you can't hear what's going on. So the agenda this morning, we're going to start with a fireside chat. I'm going to introduce Nate shortly. And the difference this time around will be, instead of me interviewing Mr. Grenke yesterday, Nate is going to interview me. And so that will be from 9:30 from now until about 10:15. We're then going to have a 15-minute pause, and then at 10:30 we're going to reconvene, and then there's going to be a panel discussion where you guys get to ask the panelists. I'll introduce the panel a little bit before the session starts, but they're all very experienced capital allocators who've supported young managers many times. So I think it's a great opportunity to hear from the people who, when you start your funds, you're potentially wanting to attract. So that's at 10:30, and then we're aimed to finish about 12 o'clock, which then is an opportunity for people to go skiing or discover the resort, or I know a lot of you also have to get to Zurich Airport to flights home and stuff. So it's my great pleasure to introduce you to Nathan Chesley from MIT. So I've known Nate, I think, for 7 or 8 years now. MIT is, I think, the most thorough organization I've ever come across in terms of trying to root out young emerging managers from all over the globe. I've never met a manager, I think, who hasn't at some point met with MIT long before me. And so I had the idea, and I've enjoyed a great partnership with Nate and MIT for over 5 years now. And I think we probably had the first conversation 7 or 8 years ago. And so over this course of time, Nate has interviewed me many times with a view to trying to figure out whether I was a potential manager for them or not. And so he's probably the most experienced person in the world in terms of understanding what I do. So I thought it'd be a great opportunity to invite Nate to kind of talk to me a little bit, so you guys get to hear the story, and also to see a little bit as well how these guys think. So, great.
Yeah, thank you, Rob. I'm humbled to have the opportunity to do this in front of this group. I wanted to start with just a big thank you to you on behalf of everybody here. This is just a really wonderful weekend, so thanks for putting it together. It's an incredible collection of people from all over the world, passionate, thoughtful, smart, motivated, and I think it reflects very highly on the community that you've built, so thank you for doing this. So the narrative of questions I have here are much more about how Rob came into the fund management business and how he's evolved over the last 10 years and also rolling forward into the future. I have lots of questions about Shake Shack and Grenke's valuation and cash and portfolio management, but those are really about yesterday and future conversations. So that's the effort here. Let's dive right in. I think we have about 40 minutes now. Again, if at any point in time you can't hear us in the back, please just shoot your hand up in case we're too muffled. So was there a specific event or series of events that really crystallized in your mind that your destination was to be a fund manager?
Yeah, I think so. I was interested in stocks and shares from a very kind of early age in life, primarily because my grandfather was very much had his own portfolio, and we used to look in the newspaper in the morning to see how the shares were doing. It was always then the price from the day before, very much different from now. So I kind of always had an interest in it, but at that time I was definitely not an investor or a fund manager. And I kind of date the point in time to where I sort of started to become what I would call an investor from around about the early 2000s. So some of you maybe will recall in the early 2000s there was this enormous dot-com crash where all all these formerly high-flying tech companies sort of were completely got completely bombed out and lost 95% of their values. In fact, many of them lost 100% of their value. And at the time, I was working in a small bank, and a lot of these companies were trading at a huge discount to the net cash they held on their balance sheet. So, as someone who hadn't at that time discovered Warren Buffett or Ben Graham and knew nothing about value investing, in a very simplistic way, I was seeing, okay, the company has 100 of cash, and the market value is 50. That feels cheap to me, and so that's kind of how I kind of got into it. And it was around that time then, when you start sort of buying things at below net asset value and stuff, then it doesn't take you too long until you come across Ben Graham, and then when you come across Ben Graham, you find Warren Buffett, and so that's kind of how the journey started.
Mm-hmm. Mm-hmm. And was there a moment in time where you, I guess, what led to the point in time where you had the confidence to say, I'm going to start my own thing independently versus be an analyst or a portfolio management at a large organization? I mean, what drove that final decision to say, to sort of leave the ship and do your own thing?
Yeah, so from that period onwards, from right about the start of the 2000s, I was sort of managing my own money, and looking back now, I'm not sure that guy was such a great investor, but he was operating in a great time to be investing, because things were so ridiculously cheap. And so, over a number of years, I was achieving very high returns on my own money, and really enjoyed the independence of being able to make the decision on when to invest or not. And if there was a mistake, it was my mistake, and I had an opportunity to then go back and think about it. And so I had a kind of a dichotomy, because as an investor, I was developing very independently, but I was working at a family office at the time, which was very patriarchal. Very nice guys, people I'm still in touch with now, but very much hierarchical. They were the decision makers. I was the guy doing the work, and rightly or wrongly, I felt I was equally able to make the investment decisions. And so it was around 2006 that I set up RV Capital, and at that time it was my big dream to manage money for other people. But I had the chicken and egg problem that I'm sure many of you guys have as well, which is without any capital, you can't start building a track record, and without a track record, you can't really attract any capital. And so I was sort of facing that dilemma, but desperate to be independent. So what I did in the first 2 years was work as a kind of an outsourced analyst for various third-party funds. So I had a variety of customers. One of them, Luke, actually is here today, who was working for an American hedge fund, and I was his kind of eyes and ears in Germany for looking for investment opportunities. And I had a client who was a listed company who was looking to make an acquisition, so I was analyzing potential acquisitions for them. And I also worked for a family office from that period as well. So that was a great moment for me, because I was independent, but I was I was an analyst at that point. I wasn't a fund manager.
And when you go back to that period of time, 2006, 2007, 2008, abstracting from the machinations of the market, what were the biggest obstacles, maybe apart from this chicken and egg issue, but what held you back, or what were the challenges to really take those first big leaps and get started on your own?
Yeah, I think it was primarily financial. So, the maths back then may be different today, but you had to calculate, running costs for starting a fund were around about maybe a little bit less than 100,000 euros, made up of the kind of the custodian, the administrator, the bookkeeper, and all that. So, to the extent you were able to attract 5 million euros of capital, it was a kind of, already your costs were kind of 2% of your assets under management. And to the extent you could raise 10 million, then it was 1%, but it was still, in both cases, quite a significant amount of performance lost before you even got started. And I wasn't even able to attract 5 million for that matter. So, the main bottleneck was really getting to capital.
A couple of questions in this domain, but you made a purposeful decision to be on your own and not build a team, not build a back office yourself. What do you think the biggest benefits are of being a one captainship, I think to use your parlance, that people from the outside don't appreciate?
Yeah, so, kind of when you look back, it's easy to kind of spin a kind of a narrative around these things, but and I think there is a powerful narrative around it, but at the time it was much more kind of intuitive and opportunistic. So, my background as an investor was just sitting in my room managing my own money. That's how I learned to invest, and so for me it was very natural to kind of work on my own. And I'm sure people who kind of maybe come from a more traditional fund management environment where they're working in a team, they have traders supporting them, and for them it probably feels natural to start with a larger organization. So that was, I felt I was being successful with my own money, so I didn't want to change a recipe that was working. And from a more pragmatic point of view as well, I thought it's super important to keep costs as low as possible, because when you start out, you don't have a whole lot of capital, and if you start hiring maybe an analyst and a trader, a receptionist, you can kind of calculate each of those people potentially can cost 50 or 70 or 100,000 euros a year to employ. Then all of a sudden you can see there's a really big amount of cash going out the door, which I really didn't want. So that was also kind of pragmatic reason to be a one-man show.
Mm-hmm. Mm-hmm. And what's the hardest part? Maybe what was the hardest part at the time of being a one-man shop, and now that you have 10 years of experience doing this, where does that present a challenge to you?
Yeah, so well, when I started, I was sort of quite embarrassed about being a one-man show, and probably didn't advertise it that much, because I guess there's a sense that to be credible, you have to have people find it difficult to judge whether someone's credible or not, and one of the kind of shortcuts is to see the office space and the number of people working for you and stuff, and so I had none of that. So to begin with, that was maybe something I was slightly embarrassed about. But an amazing thing happened in the crisis of 2008, 2009. So I kind of really discovered there was a big advantage to working on my own. So I was just sort of in my at the time I worked from our guest bedroom, and so I was just in this room kind of comparing price to value things. I knew the world was going pretty crazy and prices were going crazy, but I wasn't really infected by this craziness, not because I'm so much more rational and cooler than other people, but just simply because I was sort of isolated from it. I didn't really feel it, and I only got a sense of how kind of the extent to which people were losing their minds. I remember very clearly I attended a conference in Zurich in January 2009. And normally when you go to a conference, there's lots of investors there and companies, and in the breaks people exchange ideas about companies. And at this conference though, I tried to sort of engage people on conversations about this company looks cheap or that company looks cheap, and people looked at me like I was some kind of an idiot, and they're like, don't you get it? The world is coming to an end and you're talking about companies being cheap. And and that was kind of the point in time where I realized, wow, this is actually an advantage being on my own, because I'm not caught up in this contagion. And also, what was also great was, working from home, I had very little in the way of outgoing. So even if the markets had remained very weak for an extended period of time, it wouldn't have harmed me. I had sufficient sort of financing to stay the course however long I wanted to. Whereas the guys who had kind of a lot of overhead with people working for them and fancy leases on offices in Bond Street or whatever, they of course were really suffering because they were just seeing money go out the door, every month.
Mm. Is there anything from the early years that you attribute entirely to just good fortune, good luck? I think a lot of this is deliberate, but is there part of this that you just got lucky in some ways, and it might not be repeatable if you did the same trial from the same distribution in the future?
Yeah, I mean, it was certainly lucky that I think the way I was structured in hindsight was the right way to be structured, but there was no master plan. That was really luck and just sort of responding in a very opportunistic way to the kind of the circumstances. So that was definitely one piece of luck, and it was also very lucky to be starting in September 2008, for a number of reasons, because things were very cheap, and of course when you're starting a fund, it helps to, if things are cheap. But it was also kind of still a little bit before the crisis, so if you remember kind of, September 2008, it was definitely kind of, things were rough, but I think the crisis sort of peaked around February 2009, so roughly about 5 or 6 months later. And if you're, if you think you're a good sailor, then you kind of really need every now and then a hurricane to be able to demonstrate to the world that that you are in fact a good sailor. So I think it was lucky, also in that respect, to have started at that time. So I think there's always a lot of luck connected to these things.
You spoke yesterday about the importance of your network in helping source ideas and learn about new businesses. Could you talk a bit about, in practical terms, how you utilize your sounding boards, and also how you think about mentorship? Again, this is related to being a one-man show. How do the sounding boards work, and how do you make sure you have a mentorship feedback loop?
Yeah. No, so I think I'm like one of the luckiest people in the world in that respect, because I think I just have this wonderful network of like-minded people, and many of you guys are here today, and I kind of looking around the room try appreciate you being here. And so sometimes people ask me, I get the rationale of working on your own, but isn't it kind of mind-crushingly lonely? And well, actually it isn't, because whereas if you work in a team of maybe 5 people, I guess a lot of your interaction is with those other 4 colleagues, quite naturally. In my case, I kind of view my colleagues, if you will, as the kind of the wider community of people in my network, and it's kind of great because everyone in that network has their own particular interests and specialities and investments, and I can kind of pick whoever is most suited to a particular investment to kind of brainstorm with them on it. And these are much more talented people than anyone could ever collect in one firm. So I kind of view it as as a much more sort of powerful network than anything I could collect, or anyone else I think could collect in one company. And actually, even if you were to be able to afford, or these people, simply by them working in one firm, they would lose a lot of their independent thought just through the dynamics of working at a company and being on somebody else's payroll. So I think it's really amazing in that respect. And then, like I said yesterday, from a more kind of social, hanging out, kind of chilling type aspect of kind of colleagues, that type of downtime is more than with my family, because they're the people who are in my kind of immediate vicinity. And that's also great because I get to see my kids grow up, and they don't have a dad who kind of leaves at 7 in the morning and gets back when they're already in bed, and then goes off on long trips a lot of the time. So I think it's a really great system, and it's not a lonely system. I don't consider myself a hermit.
Sure. Maybe drilling down a little deeper, in more practical terms with your process, if you were to take the average week, or the average stretch of weeks, how often are you engaging in dialogue with one of your sounding boards on an idea? Do you do calls? Is it a lot of long form writing? In practice, how if I were one of your sounding boards on ideas, how would we engage, and how do you do it in a way that is most productive to your process without engendering bias and other things?
Yeah. So it tends to be very organic. So if someone like Matthias, who I can see here, who one day came, probably about 5 years ago, came up to me and said, "Hey, you're into Grenke leasing, which is an indirect lending business. Have you ever looked at credit acceptance?" I think he might even said provocatively, "It's a much better business." So then I sort of felt my pride sort of peaked a little bit. And then did a lot of work on, or the initial work on Grenke, and thought, on credit acceptance. Thought, well, actually, he may well have a point here. And then, of course, it's very natural that Matthias was my kind of sounding board on that particular idea, because we were interested in it. And I'm sure it was a few years ago. I'm sure we spoke on the phone several times, and then a few months later, we went to Detroit together to visit the company together. So it was a very natural, organic sort of exchange of ideas. and one where there's no real kind of pressure. So if you work in a firm and you're the boss and there's the analyst, and the analyst sort of comes, he has this great idea of credit acceptance and pitches it to the portfolio manager, and there's this kind of awkward dynamic that if the idea doesn't get taken and subsequently goes up, then maybe the analyst feels a bit sort of upset, and or vice versa, or and when it's that kind of organic exchange, there's none of that real dynamic. I don't think Matthias would have bothered him in the slightest if I decided not to invest, and vice versa. So in that respect, I think it works really well.
And do you tend to use your sounding boards for things that are active in the portfolio as well? So it makes sense during the diligence process to have a good sparring partner. But once you're invested in something, does the use of outside sounding boards tend to become less and less over time, or does that dialogue remain as you remain invested?
Yeah, I would say after the investment, so as everyone knows, after I've made an investment, I've always sort of made a point of being very transparent in my letters about where the money is and why it's there. And of course, I guess a lot of you guys read those letters, and so subsequent to that, the kind of the network which I might exchange ideas with on the company probably widened. So prior to investing credit acceptance, I'm pretty sure the only person I spoke to about it was Matthias. But subsequent to that were other kind of like-minded people. Well, some people who dislike the idea and explain why they dislike the idea to me. Other people who liked it and invested, and so I would say after the investment, there's a much wider sounding board. And I think one of the advantages of also being quite transparent in my letters is people like nothing more than to point out a mistake. And that's sort of a pain if you work in a big company, because you've got a career you want to sort of be successful in, and if a junior colleague tells you made this awful mistake, then it's probably not very good for your career. But from my perspective, I'm just trying to compound capital at the fastest possible rate. So if someone comes up to me and says, "Oh, you made an enormous mistake when you wrote this about that manager. You wrote he was an honest manager. Did you know 5 years ago he did something bad or whatever?" Then of course I'm disappointed that I missed that in my research. But I'd rather hear about it up front and then avoid a bad capital allocation decision than sort of soldier on and potentially lose money. Yeah.
There were some good questions yesterday about habits and routines, and I won't revisit the specifics of that. I want to just continue on that theme. Is there anything that you've done, recently, maybe say in the last 5 years, that's created just a ton of leverage on your time? So it sounds like having an outsourced back office creates a lot of leverage for you. Are there other things that you do with your time where you get, multiples the return on time that you might have gotten, 5 to 10 years ago, doing the same type of activity, reading or modeling or utilizing sounding boards, thinking about your process holistically?
Yeah, so there's a few things. I mean, the first one, which I think I mentioned yesterday, is, I think a much more efficient way of generating ideas for research is getting referrals from like-minded investors, where there's a kind of a pre-sort of sorting taking place. And if I compare that to 10 years ago, where I would have just taken a look at the 52-week low list of 100 companies and kind of go through all those 100 companies in a very superficial way, hoping to find the needle in the haystack, probably looking primarily at quantitative figures like EV/EBITDAs or price to book. So that was a much less efficient way than having someone who's like-minded, knows how I think, say, "Hey, I think this company here, you might like it." And, a lot of the times it isn't a company I like, and I end up not investing, but it's always a productive way to spend time. So that would definitely be one way. Another thing which I think has given me a lot of my time back is being much more focused on, when I travel, visiting with just one company and its competitors, rather than visiting 15 or 20 different companies. I think that's saved me a lot of time on that.
How do you, this is a question maybe back up at 35,000 feet, how do you think about structuring the broader learning process? So there's reading the K's and Q's on businesses that you want to go deep on, and the deep vertical of understanding a business. But how about when you think about expanding the periphery of your circle of competence or learning a new area? How structured is that process of more deliberate learning versus just deep company level work?
Yeah, so it's kind of opportunistic. So I find the best possible thing that can happen is if you come across a book which explains really well to the layperson a subject which previously he knew nothing about. I read a book about half a year ago on structural engineering. So it's basically why do roofs not fall down? And it was very well written. It was a subject I knew absolutely nothing about, and I kind of felt that I'd gone from knowing absolutely zero about structural engineering to kind of being able to hold my own on a kind of conversation with a structural engineer. Obviously not able to do structural engineering myself, but to have a basic understanding of the topic and how it works. And these things, you never know what they might be good for at some point, because a good investment comes from some kind of variant perception. So where you see something that everybody else has missed, and you get that not from reading the information about the company because everyone else is reading that as well. You get that variant perception when you see one thing from a completely different sphere. It might be a different geography, or it might be a completely unrelated industry, and you kind of take that insight there and then put it here into the company you're looking at, and then see it in a completely new way. So I think, but your question was like how structured is that? I think it's very opportunistic. I can't control when that book comes along, and when I find it, then it's great, and I kind of feel I make a quantum leap. But unfortunately, I just can't read that type of book every day because I just don't come across it.
Sure. Is there any, are there any waypoints today or any opportunistic things you're learning about that you think may add a lot of value? So is there something you've read recently or something you plan to read that fits that description of opportunistically learning about something new or building a new mental model?
Yeah, I hesitate to mention the word, but I read a couple of books recently about cryptocurrencies, and talked about it in my last letter. And I've had quite a steep learning curve on them. So my initial reaction was complete denial of any possible relevance to what I do from cryptocurrencies. To me, it just looked like a complete Ponzi scheme. People bidding up, bits of code on a computer, and all this sort of mass psychology and all that kind of stuff. And I think actually a lot of that initial reaction will probably turn out to be true, at least in the short to medium term. But what I've kind of learned is that over the long term, I think the way cryptocurrencies work and blockchain, I think that can be very, very disruptive to a lot of existing businesses, and it can create an enormous amount of change and probably value creation in the future. Just like when the internet came along in 2000, or before 2000, excuse me, nobody knew that it was going to result in Google and Facebook, but it did. And I suspect something similar will happen with cryptocurrencies. Now that's not to say by any means that I would invest in one of them. And by the way, that's because I don't invest in any currency. Currencies don't grow in value. It's like, the way to think about it is and I wish I'd thought of this analogy earlier for my letter, but kind of a currency is the golden egg, and the company is the golden goose. And if you have the choice between the golden goose and the golden egg, it would just be completely idiotic to buy the golden egg. Although the golden egg might well have value. So I don't invest in any currency, in dollars or anything. So I wouldn't invest in it, but I think it's a fascinating space. I think it has the potential to revolutionize virtually any sector, so finance, social media, or whatever. And I think it's going to be an important thing, to follow over the coming decades. And I thought maybe it was also important in my letter to signal to the community, not to kind of just sort of ignore it and say, hey, we're value investors, that's not our thing. I certainly wouldn't invest in them, for the reasons I mentioned, but I would certainly take them seriously, and I would certainly follow them because I think they're interesting.
Shifting gears entirely from cryptocurrencies.
Phew, we managed to negotiate that one.
How did you end up with the fee structure you have and the structure of the fund? I know a lot of people that we speak with ask us questions about getting the incentives right and getting the structure right. And what were the inputs to your process in terms of where you ended up with the fee structure and the fund structure that you have today?
Yeah, so I think fee structure is, there's lots of important decisions you make when you start a fund, but the single most important one is probably fee structure, because the way you kind of charge your investors kind of reveals how you think about them. So if you have a very unequitable fee structure, then you're telling the thoughtful investor that you kind of think they're idiots. Whereas if you have a kind of a thoughtful, equitable fee structure, then that's an immediate signal that you're kind of a serious person. So when I chose my structure, so obviously everybody knows that Warren Buffett, when he started his partnership, had this sort of 0% management fee and I think 25% over 6% or something like that. And and I think that's a great structure, which many of you should for sure consider. But the one I went for was a 1% management fee and a 10% performance fee over a 6% hurdle rate. And for me, and perhaps for many of you, it was very important to have the management fee. Remember, I was starting out from a very low base. I think when I started, it was about had about 7 million euros assets under management when I started, and so that 1%, gave me an income of about 70,000 euros after various travel costs and bits and pieces of other stuff. Probably left me with about 50,000, which of course is nothing compared to what you can earn in an investment bank, probably even as a junior person. But it gave me my independence. I could live from that. I wasn't drawing from capital, and it allowed me to be very relaxed in these very troubled times that I started with. So for me, it was always very important to have the management fee. And then the performance fee was important because, I thought if the results should be exceptional, then there should be a way to participate in that as a manager, and it kind of creates alignment that I only get, only get paid the big sort of bonus if the performance is really good. And then in terms of the hurdle rate, so some funds you see have a 0% hurdle rate or the risk-free rate, which is effectively also 0 at the moment. And my thinking was, either you take an equity benchmark as a hurdle rate or an absolute benchmark. And I went for the and I think both are good, and there's reasons to do both of those. But I chose the 6% because I thought equity markets over time probably return about 6%. So it will equal what an equity return is. And at the same time, a performance fee will only be payable in a year when the fund is up a lot. I think that's important for the psychology with investors, because if you choose a benchmark, you could theoretically have a situation where the fund is down 20%, but the benchmark might be down 50% or something, and of course there's a huge bonus gets paid to the manager in a year when the client's lost a lot of money. So I know there's counter arguments to that, but that was my thinking behind it.
And the structure of the business owner fund, was that really something that fit because of your relationship with the outsourced back office that you'd use? I mean, what was the decision around doing a German mutual fund to start and the inputs to that process?
Yeah. So this is maybe also an example where I was kind of lucky, I think. How did I actually get to start a fund? Very fortunately, I was sort of one of the clients when I started out in 2006 was the Rentrop family office. I managed a small pool of capital for them, which went very well between 2006 and 2008. And as a result of that, they allowed me to kind of start a fund in 2008. But they were the ones that created the fund structure, and I basically got to say yes or no to it. But importantly, their interest was always investing. You know, they had nothing to gain if whether the fund was marketable or whether new investors came in. Their interest was having great returns in this fund, and so as a result, the structure was always built around, first and foremost, me being able to allocate capital in an optimal way. So prior to the fund starting, with my own money and also this account for the family, I always invested in a very concentrated way. So at the time, less than 10 stocks in the portfolio. So that was the way I'd become successful. So it was super important with the fund structure that subsequently came along that it allowed me to do that. So I took a very unusual structure. It was a hedge fund structure, and the important thing was that it allowed me to invest in a concentrated way. So I only had 10 stocks in it. But from a marketing perspective, it was a disaster because most people can't invest in a hedge fund, and those that can normally have some kind of market neutral or long short type of expectation. And I do none of that. I have no interest in shorting companies or leverage or any of that kind of stuff. So as a result of which, the fund wasn't really of any interest to anyone. So it was kind of bad from a marketing standpoint, but it was great from a capital allocation standpoint. And that's and I kind of fell into that by luck. I don't want to take credit for that because it wasn't my decision. But in hindsight, that's exactly the right way to do it, because you know, the job of the capital allocator is to achieve excellent returns. And if you achieve those excellent returns, there's never going to be a shortage of people that want to invest with you later on. You know, people that or at least thought to be able to turn kind of 50 cents into $1 are never going to be in you know, wanting for clients. So you know, not that I'm claiming that I am that person, but you know, that's you know, I think the point is self-evident. So you know, what I always really encourage is choose the investment structure that allows you to be successful as an investor, not successful in the short term as a marketer.
We have about 5 minutes left. I'm watching the clock carefully. Have you ever had to turn away inbound capital, people that wanted to invest with you, but you determined weren't a fit for the strategy? And how difficult is that process?
Yeah. Yeah, so here too, I think I was very lucky in the early years. So when I started out, I was kind of very keen to attract investors and would probably have been very unselective about who would have invested in the fund. But fortunately, it was so uninvestable, the fund, in terms of the structure, in terms of me being a one-man show with zero track record, that you know, literally nobody wanted to invest with me. You know, as a result of which, I just stopped trying to get anyone to invest in the fund and just concentrated on managing the fund and reporting in a half-yearly rhythm to my investors on what I was doing. And kind of an interesting thing happened. So every now and again, someone would have read my letters, seen the companies in the portfolio, and thought, this guy is exactly who I'm looking for. It didn't happen very often, maybe you know, once or twice a year. But it meant every now and again a new partner was coming into the fund. And the interesting thing was, they were exactly aligned with what I was trying to do. And that was, of course, not a coincidence. It was because they found me. It was because I hadn't gone out to find them. And so it was creating this really powerful flywheel where the fund was, you know, the fund was growing because of the way I was doing things, and that was attracting people to me who were encouraging me to keep doing it in the same way. So it was really getting into a virtuous circle. So I don't want to claim credit for it. I think I kind of fell into it by luck. But I then later realized, you know, this is just amazingly powerful. The better partners I have, the better the performance is, and the better the performance is, the better the partners I have. And you know, when of course that kind of clicked at some point, I'm a little bit slow. That probably clicked after about 5 years or something. Then I very actively turned down investors that I thought didn't fit. You know, so you know, for example, I've never taken into the fund some kind of intermediary who sort of, you know, an IFA type who has various other kind of pools of capital that he or she is investing on behalf of other people, because you know, I want the owners to be invested in the fund and not the intermediaries. So that would be an example of people I've turned down over the years.
Yeah.
And I would encourage you to do that as well.
Yeah. When you look forward another 20 years, and we stand, you know, 2 decades from now, how do you define what success looks like?
Yeah, so I want to be, before I describe what that success looks like, I want to kind of be clear about, something that I've thought about a lot. So I think I read, and I'm probably going to get this a little bit wrong, but the idea is roughly correct, that in the first Olympics, the person that won the marathon ran a time which was slower than some 70-year-old could run today. So, and of course the reason was it was just a very, very small group of wealthy, kind of white, amateur people, probably from a handful of countries, that got to compete. And so what actually determined whether you won that marathon wasn't so much whether you were a good marathon runner as to whether you happened to be born in the right place. And I kind of view myself as a fund manager as that marathon runner from a century ago, because the reality is how many people get the opportunity to run a fund like I do. I wouldn't be surprised if it's less than 100 people on the planet. Of course, there's a lot more than 100 funds in the planet, but most of them, the incentives are all wrong and misaligned, and they have the wrong investors, so they don't really get to play the game to their full advantage. So with that caveat, what is my ambition? I think I'm kind of incredibly lucky to have a ticket to this marathon race. And now I'm in it, I kind of want to win it. And and the way to win it is to, the person that will be the winner of this race in 20 years' time is not the person who's raised the most assets or who's become the wealthiest or whatever. It's the person who's compounded at the fastest race rate. And all of us here in the room know that. Maybe in the press sometimes the guy who's the most famous is the one who is the wealthiest or the biggest show-off and sponsoring the most events or whatever. But the people who really get capital allocation know the winner is the guy who compounds at the fastest rate. So that's my ambition from a professional perspective. But I also have the ambition as well, from a more kind of a purpose-based perspective, is to be a great partner for my ecosystem. So I want to help the young managers who've helped me with investing ideas or potentially will help me in the future. I want to help them become successful. I want to help the managers of the companies I invest in to be successful. So that means providing patient capital to them, giving them ideas and impulses when I meet with them. And I also want my investors in the fund to have a great experience beyond the purely financial. So it's especially for unsophisticated investors, it's very stressful to kind of give a large part of your money to some other person. And when you do that, of course you want a good financial return, but you also want a good emotional return, in that you don't want to have several near-death experiences en route where you thought all the money was gone and then it's back again, and where is it, and is it all lost or is it not? I don't think that would be a great experience, even if the financial experience was a great one. So my purpose is also to take good care of my investors, and that's part of the reason why I did the day yesterday. So that's probably the three things.
Great. I have a bunch more questions, but we're out of time. Thank you.
Okay, so we have a 15-minute break, and we'll reconvene at 10:30.
You passed.
Yeah, yesterday. Yeah, you did. Oh, it's good to I didn't realise.
Just swear it out, just check. No.
There's a few that came up out of the blue here too.
I told you about it. There
You guys have an iPhone iPhone Samsung.
I have the cord, but it won't go into the adapter.
Oh, you've got the cord?
Yeah,
Yeah,
I mean-
put it into here. It's, I've got one.
It's like a reverse
That was probably the one I was
I would have felt so bad if you booked it off.
without the microphones, is it going to work on the YouTube?
Yes, fine.
Okay.
I'm checking it. I checked outside. It's all working.
Brilliant.
It's live now.
What should I say?
That's our slept terribly. Last night, initially I was expecting a double bedded cozy up, but there was a separate bed.
Last year I was in Oregon, in the same hotel. We had a proper last day, so it's just like a bigger, just one thing. We were doing that. Okay, this is going to be a bit awkward. Yeah, let's get some. But you're good to give us a lift? Yeah, right. Yeah.
Are you ready? Sure, but does this fit or should we rather You were lucky, right? But I don't know if that's the way that we can work. Yeah, I know. But maybe we can follow up in the Zurich.
Oh, okay, you're.
So, Tommy, you're going to introduce the next section, yeah? Okay. And you get the microphone, you say, hello, So, this camera here, this is going live onto YouTube so people can watch the conference. So you'll be live on YouTube. And when you say hello everybody, please take your seats. See? So it's streamed through there. Okay.
I remember your relationship I had looked at the company, but I remember you at the time telling me that he was quite and actually teaching
Okay, I'm gonna
Whatever you want. Let's go. So I can ask those questions. Yeah, that's good. It'll come to you sometime in August. I thought it was a good event. Yeah, we're an event. I'll set it up. Yeah, you go.
Oh, there you are. Good. Yeah, so
You get to walk over.
around the foreign managers, advice on these big stuff, that type of thing.
I'm very much
It's a pleasure to be here, Rob. That might be.
Yeah, no, we're really close. Yeah, it's nice. Alex, even though there's always been quite an age difference, but he's very much just been my little brother. So, no, it's really good. Hello, how do you do? I'm Alex. I'm your sister.
Well, yeah.
It's really oh, is it? Oh, wow. It's really it's really interesting how someone begins their career in this industry. And are you just starting? Is that where you want to go? Okay, fine. Oh, well, then this is very interesting. You have to ask lots of questions. Next half. Yeah, I know there was it's up very quickly.
Or is it just going to be slightly
Or if you give me a little signal, I can just pause it for 30 seconds when you change.
Yeah, sure. It'll only take 5 seconds.
Yeah, it's all on this. Oh, you have? Okay. Already, I'm really seeing it.
Wir haben uns gesehen bei also ja, diesem See. Yeah, I remember you guys. Yeah, there was this grill outside.
Okay, it's half past. You could all take your seats.
A lot on our website.
The virus could make their way.
Yeah, that'd be really fun to do. Yeah.
Yeah, he's in charge of the microphone. Good skills. You can do it again if you want. Oh, okay. Okay, we're going to see what it is.
Okay, you want to sit on my lap then? Okay.
Okay, after we start, please take your seats. Okay, so we're going to start the afternoon session. Okay, welcome to the final session of the weekend event. So we're going to finish up with a panel discussion. Okay, I'm going to turn off the microphone. It worked before, okay. So we're going to finish up the final section of our weekend event, and it's going to be the panel discussion. So an opportunity for you guys to come to step up to the microphone, figuratively speaking to the microphone as well. So you can step up and ask your questions, and I'm super happy to have three, I think, really first-class panelists, but also three diverse panelists with very different but complementary approaches. But what all three have in common is that they, in the past, allocated capital to managers, actively sought out managers, and so I think it's a great opportunity for you to kind of ask them the types of things they look for, the types of things to avoid, and yeah, I'm looking forward to hearing what your questions are. So I'll quickly introduce everyone to you. To my right here is Georg Stolberg. I'm going to say that twice, Georg Stolberg, because last year after the discussion I had about 20 emails saying, who is that guy? So this is the man, so on by popular demand he's back. He is Germany's answer to Charlie Munger. Very strongly opinionated. He's also won captainship, similar to me, but whereas I look for companies, he looks for managers. And Georg came across me very early on my career, was very supportive of me, encouraged me to kind of stay on a straight and narrow path. And you know, I don't think I would be standing here today if it wasn't for some of Georg's influence. Then next we've got James Ferguson. James works for Global Endowment, which is a large fund based in the US. A lot of the original capital came from Duke University, which is, I think, considered to be one of the best endowments in the US. And I had the great fortune to meet with James, I think about 5 or 6 years ago. And he was one of those crazy people before, you know, when I was still very small and people weren't, I wasn't really on anyone's radar, who had the energy to kind of find me and also the kind of the courage to invest with me, and I'm super happy that was the case. And then finally, we have here Gerhard Schörning, who I've known for many years as a fellow fund manager for many years. Gerhard was the co-founder of Ennismore, which is obviously a fund which is very differently structured to the way I am, but also incredibly successful. They're really one of the good guys. Gerhard co-founded it many years ago, stepped back from it, I think probably about 5 years ago. Or
no, much longer.
Longer than that.
2006.
2006, so time really flies. Since then, as a private investor, but above all, an entrepreneur. He sits on the board of a regional newspaper in Germany, and also had the courage to take over the race course in Berlin, and is attempting to kind of turn that around, not so much for financial purposes, but to give something back to the community there, and also I think as part of his passion for racing as well. So those are the panelists. The content though will come from you guys and your questions, so I'd encourage you to step up to the microphone and ask whatever you want. So who's gonna be brave and ask the first question? Yeah. Well, there's no microphone anyway, so if you want, you can. Oh yeah. Step up, yeah.
Well, I wanted to ask you, Rob, I wanted to ask you about one question.
Mm-hmm.
If you would start your investment fund again in 2008 with your today's knowledge, what would you do different?
Yeah. So, I think, when I talked about how I got started in the last discussion, I think I did a lot of things right, but without knowing it.
and really it was really a kind of more of a matter of luck than of planning. And so if I had the opportunity to do it again, I would probably make those decisions much more consciously. But I think the way it was set up would be very similar.
Could I ask a second question?
Sure. Maybe try and include the other guys, because I think everyone's heard enough from me.
So it's about modes. You invested in Facebook.
Yeah.
And I was thinking, why do you don't think that Facebook will end like MySpace?
Yeah. So the purpose of the session today is more about sort of we can take that question later offline. But
Okay.
Yesterday was more for the investments, and today is more about sort of fund management and manager.
All right.
But maybe you have a question for the guys here.
All right. I'm not sure right now. Maybe later. Thank you anyway.
This is going to be a tough session.
Hi guys, maybe I have a question for you. Rob in his letters writes a lot about that track record shouldn't be the only measurement in how you evaluate an investor, and he talks about the intellectual consistency and also the earnings growth of the companies in the portfolio. How do you think about that when you allocate capital to, especially when it comes to maybe also managers that don't have a track record? What do you look for? Do you agree with Rob's statement on this, or how do you think about that? Would be curious to hear your answer. Thank you.
Who would like to go first on that?
I'll throw something out.
Yeah, great.
I think we were talking about it last night with a small group, but track records are really interesting because you need such a long period of time to say that the track record is statistically significant that probably something about the fund's changed by the time you get to that point. Or the people that created the track record are no longer involved. And so it's interesting with performance. At the end of the day, that's all any of us really care about. But we view that as an outcome, not something that you actually target. And so the process versus outcome, I think that really resonates. Thinking about why someone does what they do and then what actually happens as opposed to just focusing on the outcome. And I think there's an analogy in sports where if you played basketball and all you did was watch the scoreboard the whole time, you wouldn't do very well. But it has that sort of equivalent.
I would say people shouldn't sound formulaic for me, and I just ask them, give me examples. Tell me about your great ideas at the moment. Why are they great? And then just get a feeling for the sort of depth of analysis, thinking behind it, and is it consistent with their philosophy?
Yeah, I mean, in the end, numbers is all that counts, and basically nothing else. But the track record, unless it's very long, doesn't really say much. And I would even say anything less than 10 years is not worth a whole lot. I mean, you're approaching 10 years and it looks satisfactory so far, but it's not. But it's not a guarantee. So the likelihood rises that it was not pure luck and there was some skill involved, but you don't know for sure. But even if you knew, it doesn't mean that in the next 10 years you'll be equally good. So it's all guesswork. It's maybe intelligent guesswork, but it's never much more than guesswork. That would be my opinion.
Yes, I can ask from here.
Yeah. It's a virtual microphone.
So my question is about this tough situation to get started, this chicken and egg situation. And it seems to me that there's also, I mean, listening to you, there certainly are a lot of helpers around it. And my experience too is that that the ecosystem is very important. So the question to you is, have you ever thought about creating something like an environment where you can more actively help young guys to get started, rather than waiting for the next Warren Buffett type of person to emerge out of this tough situation?
I can make it very brief. No, me personally not, but I think what Rob's doing here, just with that intent, is a really good initiative.
Yeah, I don't have an institutionalized setup where I help young people, but I usually have time, and somebody who wants to get a meeting gets a meeting, and I will be very clear and sometimes not very polite. But at least everybody knows exactly what I think, and maybe that is of some help. probably also very often a source of frustration, because some people leave me and they say, oh, I should better not have taken that meeting, but that's all I can do. But it's usually the more thoughtful guys that, come and ask for advice.
How often do they take your advice?
I don't know, probably not many times, but they ask.
Anyone else want to add something there?
I'll throw out one more thing. I think one of the harsh realities is that this is one of the most competitive fields in the world, and despite the fact that we all, on our side of the table and your side of the table, everyone wants to do very well, the reality is that almost everyone will fail. And so it's a strange sort of conundrum where you want to be extremely helpful to young fund managers and help them get up and come and hopefully have outcomes similar to what Rob has had. But the reality is it's just incredibly rare. And so if you were to go set up, say, 100 fund managers, the odds for both the manager and for us on the investor side are actually quite poor. And so I think doing some of the things maybe a little bit more informally, like you've done, Gaylord, or some of the communities and ecosystems that you've created, Rob, are maybe a better way to do it.
I think Jerome was next.
I have a question about investor communications. Curious what the panel thinks about managers disclosing the holdings that they have in their portfolios. Because there's sort of two camps. There's one camp that I think quite convincingly says, if I talk about the holdings in my portfolio, I introduce behavioral bias, and I don't want to do that. And there's another camp, where you probably fall into this one, where actually you want that behavioral bias. You want to build your conviction, do well by your investors by being transparent. What's the panel's view?
Yeah, I think transparency never helps performance. It's basically marketing, and as such, I accept it. And of course, it helps you maybe evaluate the manager. But if I have made a decision, let's say in Rob's case, I would prefer if he would be totally intransparent, because I think it does introduce some bias. Maybe it's not all that harmful, but I mean, for instance, last year you talked about Facebook. I think it has become more difficult for you to change your opinion on Facebook very quickly. Now, maybe you don't have to change your opinion on Facebook, but there's absolutely no way that you can convince me that this helps you in terms of performance. But maybe it attracts other investors, and it gives people a cozy feeling of being in the loop. But if somebody tells me that he's totally intransparent, that's fine. I really don't mind. And in fact, if somebody is too transparent, that really turns me off. Because all these stock stories, I mean, to me it's almost a waste of time, because it's always presented in a way that you have to agree with it. I've never read a stock story where I say, oh, this guy is full of shit. You always go and say, yeah, right. But he might, because he does not present the things that might be negative, or he might not even see the negatives. Like the guy yesterday, he saw some potential, problems, but that was not in your letter, and he might be right and you might be wrong. But being too transparent is not a good idea. But you can maybe demonstrate your thought process once in a while, or in terms of positions that you have sold in the meantime.
Can I respond to that before I pass over to you guys? So we never argue, but we do sometimes disagree. I think there were some very powerful reasons. I think there's good arguments for both sides, but when I started, I think it was absolutely the right decision to be very transparent with where the money was. So firstly, in the context of the time, so probably actually, it was certainly the case, and it probably still is now, but hedge funds across the board were completely intransparent with investors. And that was basically a marketing gimmick to imply that they were such geniuses that the normal mortals wouldn't be able to understand what they were doing. And the reality was, it was there was no magic behind what they were doing. It was that was sort of a marketing-driven thing. And the second reason it was that I thought, given that at the time I was completely unknown as a fund manager, I felt confident I might be able to build a good track record.
But I thought, that might not be enough to be successful as a fund manager, because if there's hundreds of people starting a fund, of course after 5 years there's going to be a few guys who have great performance. And so by documenting my ideas very clearly, a priori, where is the money, why is it going there? I felt it created a more credible track record than a purely quantitative one. So I think, and then the final point was, I was always concerned that the investors should feel comfortable about where their money was, especially as I was an unknown manager, as a one-man show. And I thought it was a service to the investors to kind of know and understand the rationale behind where their money was. If I scoot forward 10 years today, I'm always very reluctant to change stuff which is kind of been part of the recipe that's made me successful. But as you do become better known, maybe some of the reasons that I mentioned that made sense at the beginning make less sense today. So perhaps it makes sense to reconsider that. But that's kind of how I think about it. And especially to the young guys who nobody's ever heard about, and right at the beginning, I would encourage you to be very transparent, because nobody cares what you're investing in anyway, because they don't believe in you. So at least you're giving yourself a chance to document your track record and grow a loyal following of shareholders by being really transparent about what you're doing.
I'd be completely in favor of transparency. I have nothing to add to what Rob said. Completely agree.
Why?
Because I mean, investing is long term, and you don't instantly see the outcome. It takes time, and so for me, I would just want to know what is the thinking behind big investments? Is it is it consistent with the style, with the philosophy? But it's probably also my personal bias. I'm quite analytical. I've invested myself. And so therefore, if I understand the strategy, I'd also like to understand the large positions selected, and just to give myself comfort that it makes sense. And I don't have that chance, and it's okay. And another example would be in a long-short equity fund. I think if you don't get the implied returns on the long book, on the short book, to me that would be a bare minimum, and then it would help me to ask deeper questions. I don't know, did a large position go wrong? And particularly at the beginning, that all gives more comfort, which can only be helpful. And I think the disadvantages are comparatively minor.
There is no contradiction to what I said, by the way.
Of course not.
No. I just wanted to make clear, I understand if somebody is transparent to attract funds and to give their investors a comfortable feeling. But I'm just saying, from my perspective, once I'm invested, and I talk to Rob once in a while, I would personally prefer that he is not transparent at all. But on the other hand, it's not a big deal that he talks about a stock once in a while. But I just think it never helps performance. It never helps the manager to create performance being transparent, but it helps his investors, and it helps his ability to attract additional funds or keep the funds he has. Because sooner or later you will have a disastrous year as well. Worse than last year.
Georg is in charge of keeping you grounded. Tim, did you want to
I'll try
to chime in there?
No.
Don't be scared. Okay, I think,
I got a question with Georg. Rob introduced you as somebody selecting fund managers, and you then said that the track record is probably not the best measurement. So what are you looking after? How do you select?
No, I say track record, if it's long enough, is probably the best criterion, but they are usually too short to draw meaningful conclusions, and you want to be early. Ideally you support a manager very early on, because that makes for the best relationship, and whether somebody has 0 track record or 3 years doesn't make any difference. It's worthless, you know. It's nothing. So you have to draw your conclusions from other criteria. And as I said, it's guesswork, but at least it's qualified guesswork, and you can. I think if you do it well and you have experience, your hit ratio can be somewhere around 80%. But of course, the track, if you have a 25 year track record, yes, that's very powerful. But 5 years isn't. 10 years is, yeah, it starts to be meaningful, but it's not a sure thing yet.
Yeah, I just had really maybe along the lines of the transparency, but just spending time with people to understand why they're doing what they're doing, and then as you get to know them over time, seeing how things played out or how things transpired, and then how they react to that, how they changed their mind, how they didn't. I mean, that's ultimately, I think it's not that different from picking a management team within a company where you're looking for what did they say, what did they do, how did they react, did they change the story when things were going in their favor, or did they change the story when things were going against them, or was it relatively consistent over time? So not looking for someone who's flawless or not making mistakes, but you're looking for, more importantly, what they said, how they reacted, and why.
Pass. I can't really add a lot to the question.
Alex, if you want to...
It was not a question, it was just a remark on this transparency thing. Because you mentioned that you don't think that it's helping the investor to disclose the investments, but if we know about the investments, we can challenge him. I mean, you can spare his like-minded individuals, and if nobody knows about your position, it's very difficult to get feedback from the outside. And in the end, it's about making better capital allocation decisions. So in that sense, I personally also disclose my positions to get feedback.
Yeah, I think you can do that on a one-on-one basis with certain people that you respect. But the more you expose yourself, the more barriers you create. I mean, the worst example is probably politics, where a campaign, an election campaign, you know, where you come out with all kinds of promises and statements, and then later on, you feel obligated to fulfill them, even though you might in the meantime have learned that it was complete nonsense. So I think you should always reserve the right to completely change your mind, and it happens often enough on all kinds of matters, and therefore I don't think it's a good idea to expose yourself too much. The same logic applies to politics. I mean, ideally you want a politician who doesn't expose himself at all during the campaign, but of course then you don't get elected. But it would be a perfect situation to get elected without having said anything prior to election day, and then doing things that you feel are right. But that of course doesn't happen in the real world, and I think that's the analogy. And therefore I said, yeah, I understand why people feel compelled to do it. But if somebody tells me, oh, I'm intransparent, do you mind? Of course, I don't mind, not at all.
One at the front here, and
Okay. So sometimes you decide to invest in a new manager, and after a while you realize that that you were wrong, that this was not the right manager for you to invest. So I would like to understand what are the reasons why you were wrong, and what is the process that you follow since you have your first red flag until you decide to completely pull back from this manager.
I think it depends on the situation. It could be broken promises, it could be obnoxious behavior, it could be...
What's an example?
Can you give some examples?
Yeah.
Feel free to name names.
Yeah, I probably better not do it.
You won't tell anyone.
But I've actually invested with someone, and I still am invested with him, and then for another fund he raised more capital, and he got a meaningful allocation from me. In fact, it could have been something like 50%, but then it turned out that he raised much more, and then it wasn't it wasn't 50%, it was something like in the order of 10%, but at least, 10% is something. And I asked him a question via email. And then he said something like, well, if you have any questions, come to my investment meeting, which happens to be on the west coast of the United States. And then I said, well, it's just a question, and and then he said something like, well, as you know from my writings, I don't do one-on-ones, and if you have a serious question, come to my next meeting. So later on, it turned out that my question was exactly to the point, because he later had to. I cannot reveal much more because then anyway, I was completely right. By the way, I'm wrong often enough, but there I was completely right to ask the question, and he was just totally arrogant and stupid, because arrogance is a form of stupidity, and that changed my mind. Yeah, and then I don't care how good the numbers are, because they will probably get worse. That's another observation. Track records never get better, they always get worse. The best case is that it stays good for a long time, but it doesn't get better.
I'll throw out two examples. I'm not going to name names to protect the guilty. So this one manager in particular, the change that occurred was really from a temperament standpoint. So the first sign of this was you could see a significant swing in the manager's gross and net exposures. And so typically, at least from my experience or from our experience, when a manager swings their exposures around, it's very unlikely that they get that right, and it's almost certain that they're going to get that wrong. And the damage that can do, not only to the fund itself or to the individual investments, but also to the manager's temperament, I think is quite severe. And so in this case, you could see as a position was starting to go against the manager, and then subsequently the performance, the manager started to lower their gross and net exposure quite dramatically. And so the mistake we made in that case was really from a temperament standpoint of this manager, despite wanting to do really well, sort of what I alluded to earlier, he wanted to have a great track record, he wanted to have great results for everyone, he just really wasn't wired to run towards the fire, or to at least resist the world telling him he was wrong. And in this case, he was wrong on one position, but he was right on several of the others. But he was basically inflicting damage on not only himself, but on us as well. And so we ended up seeing him in person. We talked about what was going on, and then ultimately came to the conclusion that we needed to redeem because it was a temperament issue. And I don't think that's something that's really addressable or learnable, or really something that you can improve. I think that's something that you either have or you don't. The other thing I would add is, this is sort of funny to Georg's story. I think the more transparent you are with your investors, similar to what Rob has done, the ironic thing is the less time you need to spend with them. And so, like in this case, where he asks a question and then doesn't get an answer, now Georg has to spend more time, potentially hurts the level of trust with the manager. Now the manager is getting more requests from you, the investor. And so it hurts both parties in that particular case, whereas when you're always really transparent, always really open, provide your investor with what you want, ironically the outcome, I think in a lot of those cases, is that you, the manager, spend very little time with the investor, and you, the investor, need less time with the manager because you're more confident in the relationship that you have with them.
Yeah, I've allocated capital at company level, and I haven't really professionally selected managers, so I can't really add a lot.
Did you ever have to fire anyone when you were at Ennismore?
You mean investors?
One of the fund managers there?
Yes, actually, well, fire. I mean, our model at Ennismore has been slightly different from Rob's. We then thought a lot, I think, using a book by Michael Porter, I think from good to great. And I think the key question it asks really, what is at the core of the company's mission? And we then identified it wasn't really finding good investments or the existing team doing well, but was really producing further new fund managers that were of a high return but low risk mindset, and that was incredibly important. And I would say probably out of 10 analysts we hired, only quite a few made it to us actually giving them capital on a trial basis, and then yeah, a much higher percentage of those then turning into fund managers that were given proper books. But you know, we had, just as an example, one analyst who was very diligent, loved analyzing, looked at all the pluses and minuses, but he couldn't really come to a decision. And you know, when we then said, "Oh, come on Friday, let's really talk about it," I think he sort of literally passed out, and he just couldn't. You know, it was sort of quite similar. It was very clear he didn't have the temperament to come to a decision. And so again, what was said before, it is very, very competitive, and you need the right temperament, you need intelligence, you also need to, I think, be socially skillful. You know, you shouldn't be arrogant. At the same time, you should be probing in certain situations, and it is actually quite tough to get all these things right. So it is very competitive. I don't know. Has that answered the question?
First class. I mean, what I took away, it was never about acumen. It was more about being too risk-seeking or too indecisive. More the kind of more an emotional level than a ability level. So, well, there's lots of questions. Constantine, why don't you go next? Oh, sorry, you're next. Okay.
Professor Bruce Greenwald is quite famous for saying that all generalists are suckers. So he regularly mentions this at his class at Columbia, and I was wondering what your opinion is about that.
Was the quote all generalists?
Yeah, all generalist investment managers are suckers. So you suggest being specialized on individual sectors, industries, as opposed to generally investing in everything else.
Yeah, I think that's totally wrong. In fact, my observation is exactly the opposite. Specialists very often disappoint because they have a narrow universe, they are overconfident, and they fall in love with their companies or whatever. So, I mean, just look at Warren Buffett. You know, he is the prototype of a generalist, and not exactly unsuccessful. So I don't know in what context Professor Greenwald said that, and I know his book, and I think he's highly regarded, and he's not stupid, but that sentence by itself just doesn't make any sense. So I doubt that he really meant it. But you want, in my view, the best chance for good rates of returns is if you have somebody with a very wide universe, basically unrestricted, who then selects a very tiny subset of that huge universe in companies that look idiot-proof to that investor. Whereas if you specialize on any particular sector or country or whatever, that usually caters to the institutional world, which is already a very bad sign, and it traps you inside something very narrow. Why? Why would you restrict yourself? Why would you not be open to the world? I mean, especially now where you can easily invest in a company in China or in India or in the United States or wherever. Why would you build these barriers? It doesn't make any sense. And as Rob said this morning about gaining insight, I think it's all about context. I think any information or any data point in isolation is worthless. You have to put it in context. And the wider that context is, the more likely you are to find something which other people don't find. That's why he said you have to read other stuff, and at some point the dots connect, and once in a while, not very often, but once in a while you have an insight that nobody else has. And therefore I would say that's definitely totally wrong.
Yeah, James, have you ever invested in a specialist fund manager, or are they pretty much all generalists that you have?
So almost all of our managers are generalists, with one exception. So I think one's like a long short biotech fund. So I think there are areas where you have a pretty significant level of technical competence that you need. notwithstanding the conversation we had with someone last few days on learning cell biology to expand their circle of competence.
I might know who that was.
I do think there's certain areas where you can gravitate towards that, particularly on the private side as well. So if you think about venture capital, sort of an obvious one of, if you focus on venture and public and you do a lot of different things, maybe that's not the best way to do it. From the public perspective, though, I think our managers categorically, the global go-anywhere managers that invest across sectors, geographies, really look at companies around the world, those consistently have done better than the other managers. I think for the reasons that Georg outlined.
And maybe distressed investing is something where you need a very specialized expertise, yes.
Along with sharp elbows.
What?
Along with sharp elbows.
Exactly.
Georg, Ennismore is more focused on smaller companies, so maybe you have a different
Yeah, I mean, again, I think Warren Buffett says it's incredibly important to stick to your sphere of competence. And so I think the question is, what exactly is that? And that can vary a lot from person to person. I can only talk from my own experience. I have a small mid-cap background. I think there are great arguments in favor of small and mid-caps. They are under-researched, they are structurally mispriced. You can really have an edge if you check out things for yourself in a very similar way to what Rob has been telling us. And there are certain sectors where you feel, yes, you understand it, or you are lucky enough to learn about it through meeting companies. And so I definitely wouldn't say, for a small and mid-cap investor, if someone comes along and says, oh, I'm happy to invest into absolutely anything, I'd find that off-putting. And I would feel much more comfortable if someone came along, oh, I understand certain sectors really well, I have experience in that sector. And so I would take a sort of middle position probably. But ultimately, I think you have to be happy with the area you, invest in. And I would say when I talk to fellow investors or very rarely analysts from banks, I think you can find out pretty quickly whether they are just making broad statements that are not really backed up by a real understanding. And then passion is also very important for what you do.
Thank you.
Okay. You have the next one?
You spoke about one very important point of performance fee and how to structure the performance fee. So you have now an absolute structure like X% and then X% for a certain hurdle rate. And you also saying that there is a pros and cons of both way of this absolute way and the way of choosing a benchmark so that you have a relative comparison. So I would like to hear your view of how do you measure managers. So do you prefer to have like an absolute way as Rob has, or you measure managers on any kind of equity benchmark basis? Because I'm working for Morningstar, and I think 90% of the asset management business, they choose a benchmark and they use this benchmark to gather asset managers under management. So what is your views on the absolute performance fee basis and a related one?
I think absolute, both is okay. I just think an absolute basis, like 6% is just simpler and easier. And it also emphasizes the long-term nature of investing. That's why I prefer it. Yes, of course, if you have a shitty few years, you might not earn a performance fee, but in the long run, I think it's extremely likely that the return pattern of the past will be repeated. The long-term return pattern. And I think equity returns of 6% are almost guaranteed, probably a bit higher. So, but I prefer it to be super simple, because when you start to work with benchmarks, then it gets complicated, and then exactly what he described in the morning happens, that you have a down year, but you're only down 20%, and the benchmark is down 40 or 50%, and all of a sudden you get a huge performance fee. That is, from a psychological perspective, quite detrimental. So therefore, I clearly prefer an absolute hurdle rate. And the other thing you refer to has nothing to do with the hurdle rate. It's just what benchmarks do you use to measure the performance of your managers. And I think since I don't measure the performance of my managers in the short run anyways, it's not so important whether you use the S&P or the DAX or even the Dow Jones or something, or the MSCI World. If you take long-term numbers, I insist that my managers outperform the benchmark by several percentage points, and not just a few basis points. You know, if somebody outperforms by 20 basis points, that's nothing. But you know, at the very minimum, 3% better between 5 and 10, and then it doesn't really make a difference whether you use the Dow Jones or the S&P or the DAX, because it comes out to about the same. So only if you start to measure your managers on a short-term basis, which I don't do, then of course it's maybe you have to think more carefully about what benchmark to use. But generally, this whole benchmarking is bullshit. You know, I mean, I think it's.
Yeah, I totally agree, because actually the rule is that you have to have a benchmark sometimes. It's totally up to you what kind of benchmark you can choose, and this is totally manipulated.
Yeah. But if you do choose a benchmark, choose the one that the total return index, because otherwise it's an insult to my intellect.
Given that you work for Morningstar, we might edit that comment out.
Yeah, I mean that's many managers, especially on multi-asset funds, they can take any benchmark that they want. When only equity manager have to have a benchmark, because that's the regulations in most of the countries. For all the other funds, I mean, they can even take the Econia or the TV, whatever shit they can take to have a benchmark. So, but I can also understand, like you, if you have you are institutional investor, and you have to optimize your asset allocation, and you have a certain obligation to your investors. So you have to have a policy, and some of the endowment or system here, they have to have a benchmark, right? So how do you deal with that?
Yeah, I mean, in terms of the individual manager, I would echo what Georg said, that the absolute return is really what you care about. And in the very long term, you do care about relative, in the sense that if you think equity markets will deliver 6% return, the manager needs to beat that in the long term. So sometimes you'll hear managers say, you know, performance hasn't been as good, but they've created it in a very high quality way. Sorry, at the end of the day, that's just not good enough. If you think about it over a long period of time, because we can't go to our investors, and if you think about an endowment where they're spending 5% of their capital to fund grants and operating expenditures, you can't go to them over a long period of time and say, we generated the returns where you're destroying your endowment, but we generated them in a very high quality way. Like, that doesn't work. And so at the end of the day, you really do need both the absolute and the relative. In terms of asset allocation, optimize the funny words. Our asset allocation is relatively fixed over time, just because if you said, what's your view on markets this year, next year, et cetera, my general answer would be no view almost all the time. And then if you push me, I can come up with a view, but I have no confidence. So that doesn't give me any confidence to go and change something in our portfolio in terms of, you know, adding 20% of the portfolio in XYZ market or XYZ stocks or bonds or any other flavor of some other asset class. And so the idea is really that the managers themselves and the long-term allocation of the managers and significant equity exposure will drive the returns over time versus us making market calls.
Yeah, I can't really say a lot. I'm a private investor in Rob's fund, and I think his fee structure makes sense and is very fair, but beyond that, I'm not really an expert on fee structures.
Thank you, Gerhard. It's always nice to have a friendly commenter, you know.
No, but your fee structure is okay. I mean,
almost sounded like a compliment. Okay. Yeah. So.
Hi guys. One of the ways that this chicken and egg problem is solved, some managers solve it by doing a seed deal where they give up some economics or even ownership of the business and accept the the office or even different type of institution. I wanted to hear your thoughts on that kind of structure, that kind of manager, and some maybe scary cases of how this structure goes wrong. If you've seen it goes wrong.
Which structure?
Accepting, let's say, there's a family office that wishes to give a seed investment for a small manager that's significantly more than he's managing, and basically it's putting him in business, but asks for 10% of the business or asks for 20% of revenue while the investment is there, or something similar to those lines. So basically, manager giving up some of the economics to get in business and get assets.
I think that's a great question. So, are you guys in favor of that kind of deal of I give you capital, you give me part of your company?
I think it's a rotten deal, because either you believe in the manager and his ability to generate returns, and then you let him be independent, which I think is extremely important in the long run, or you don't really have the conviction, and then you let go. But if I have to incentivize you to be an investor by giving you a stake in my company, that doesn't sound right to me. I know from the investor's point of view, it's sometimes you have to accept it because it's very difficult to get started, and you might say yes, and in some cases it works out fine, and in many cases it doesn't work out so fine, and it starts to be really annoying when you get traction and start to generate serious money for your investors and yourself. So if I were to believe in a young manager, and even if I had the leverage to ask for a stake in his business, I would never do so, because I think it would be an insult. Really, it's a total no-go. And if people do it, I have also a very strong opinion on people who ask for that stake, unless they contribute in a major active way. Then it's different. But if they do absolutely nothing except giving capital and asking for a stake in the company, I think that's outrageous, honestly.
I don't know if I have a lot to add there. I think we've seen a couple of them we've actually seen, I think there's a fair number of them that have been pretty successful. If you think about the Tiger model, that's basically what Julian has changed to over time, is putting a lot of young fund managers in business, and maybe you could argue that the name there helps the manager raise more capital, and so they can hopefully stop raising capital quicker and therefore focus on investing. I don't know if that's true or not. It's certainly not on every, it's certainly not looking at every single one of those funds. But yeah, I agree with you generally that it puts the incentive in the wrong place, and particularly if it's capacity constrained. So if it's a manager they're just picking large caps in the US and there's some capacity limit, but it's very, very high, it probably impacts the management company or the business itself a lot more. If it's a smaller business and let's say you have 200 million of capacity, then losing the incremental fees for the manager is very hurtful, and so it puts you in a bad place, assuming you get to that point. But you're still faced with the chicken and egg, one or the other. It's either today or then.
Yeah, again, I completely agree, and for that reason, when we set up Ennismore, we never considered anything like that. And I mean, generally, maybe widening the question slightly, I think when markets are easy, then it's quite easy to attract money, but it's often harder to get the good performance. When markets are tough, you probably start with much lower assets, but it's generally much easier to start well in performance terms. And out of the two, I think the second scenario is probably more attractive, because that highlights you, and then investors will come if you generate strong performance. And usually I don't know, sometimes you have markets that are sort of medium, and it just varies, but there's no sort of ideal scenario. You just have to live with what you've got. When we launched Ennismore, we marketed in the autumn of '98. That was during the sort of emerging markets Russian crisis, and we saw people absolutely everywhere. Then we launched 2 funds. funds. We had a hedge fund, we had a big lead investor who dropped out, which then meant a large investor 2 and 3 dropped out. And so we suddenly had a situation, rather than start with a, I think, 70 million fund, we had 2.5 million in that fund. And we then decided at very short notice, sort of, is it still viable? Shall we pull it or go ahead? And then we were so fed up with marketing, so we just did the numbers and thought, well, if we can generate good performance, it's actually great. You know, on the small cap side, if you are capacity liquidity constrained, very often you can give a 10% position to a, let's say, 20 million fund, whereas in a 100 million fund you can only give it 2%. And then if it's doubles, you can work out for yourself. You know, if you start small and invest in an illiquid asset class, it is actually great to start small, and you can get some really good numbers.
Andrea?
So question on managing success. In terms of your existing managers, what kind of conversation do you have about limiting new money into the strategy? How important is this? Is this something you discuss from the outset? And maybe a refresher from Rob about how he's thinking about it.
What I usually ask in the beginning, and I write it down. And then years later I see what they do. But I never bring it up actively in a conversation because I want them to do it on their own initiative. And if they don't, it's usually bad, but sometimes circumstances have changed and they have a good reason to leave the fund open. But you know, if they, for instance, close the fund and then they put out a letter where they proudly say, well, you know, I'm doing what I said and I'm closing the fund now, but at the same time they're opening another fund, you know, that's cheating, and that would be that would be very bad. But I'm not my manager's teacher. You know, they have to come to the good conclusions themselves, and I watch behavior, and I've sometimes made the mistake that I have kind of tried to give advice or suggest something, and it was a mistake, because if I have to tell them what to do, you know, then that's already that should be unnecessary. They have to know what is right and what is wrong. But yes, I always ask, well, do you consider closing the fund at some point? And then sometimes they have an answer and sometimes they don't, because if they start with something like, if I had asked Rob in the beginning, well, when do you intend to close your fund, that would be a stupid question because it was so early on. But sometimes there is an answer, or if I come in later, and then I write it down, and I never bring it up. But when they hit the threshold, then I watch them carefully.
So we also write down the numbers. We're probably a little bit more active in terms of talking about it over time. Because on the one hand, we want managers to stick to what they've said, but on the other hand, we don't want them to be too dogmatic about, like, sort of manager we're investing with. They put a $500 million cap on their strategy. The strategy has 3 times the level of market cap that it previously had. And so they're sort of wrestling with, do they hold the line on the hard number they gave, or do they do something in between? And so we wanted to have a conversation around that. I think in this particular case, the manager has been really thoughtful about it, but because of the team, in this case it is a team-oriented strategy, we didn't want them to disincentivize the team just because they'd drawn this hard line in the same 5 years ago. But more often than not, the experience is, whatever the cap is, it's 2 or 3 or 500 or whatever $1 million away from wherever you are now. So we've had some pretty fun experiences where you go back and look at the notes and I'm gonna close at $1 billion, I'm gonna close at $1.5 billion, I'm gonna close at $2 billion, and onwards and upwards.
Yeah, I think at a small capacity was incredibly important, us having a small and mid-cap strategy, and we closed the funds probably about a year after launch, or maybe slightly longer. and then operated a waiting list. We had very few that left us. And I think then only after several years when we invested out in, that we then created the extra capacity by having nurtured, as I said earlier on, analysts that were then given small amounts of money. Once we were pretty happy that they could run the book, they were then given money, and so we could increase capacity gradually.
And then update on my capacity. So when MIT and Nate decided to invest with me in right at the start of 2012, they asked me to kind of fix at what level I would close the fund on a 5-year view, so not forever because of compounding and stuff. And so we agreed that the fund would be closed at 400 million or it wouldn't go above 400 million after 5 years, and then after the 5 years we would then sit down together to see if the 400 million still makes sense, and then as necessary adjust that. And so at the start of 2017 I was around about 300 million US dollars, and thought I was on cruise control to get to kind of the 400 million by year end. But then in US dollar terms the fund returned 50%, so I blew through the 400 million into the year 450 million. But I think they've forgiven me. And you know, because of the nature of compound economics, you know, a cap can't be set in stone forever just because of the way the money compounds. It just automatically becomes more over time, and of course the investment universe compounds as well. So you know, I think it does make sense that you know, that level gets you know, reset every 5 years or so to reflect that. But it should, of course, never go above a level where you're no longer able to find opportunities. Sorry, was it Sam?
Well, it's too bad that Matthias left right before, but yesterday I had this conversation with him where I explained to him that I have two kind of structures, like one is a managed account and one is a stock company. And with the stock company in the medium term, I want to also engage in medium and small enterprises and provide permanent capital in the real economy and not only in public stocks. But for now, the portfolio totally overlaps. And when Matthias heard that, he kind of told me that I cannot win at 2 races. I need to decide which one I prefer, and if I prefer the stock company, I should tell the foundation to give him my capital so that he can focus on investing it and I focus on the stock company. So I want to ask you, do you agree with that point of view, or is it possible to engage in public stocks and over time also start to provide capital for small and medium-sized enterprises?
So from a manager perspective, I think about our portfolio, both existing as well as managers that we've seen in the past. The number of managers that can successfully do public and private combined is, it's not 0, but it's pretty close. I think part of it is the cadence, sort of the cadence on, if you think about how you spend your day. In the most basic sense, as a public investor, the ability to create a transaction is simply pressing a button. And so the real question is whether or not you want to create that transaction, whether or not you want to buy the security or sell the security. On the private side, almost all the time is spent around access, the ability to put together the transaction, manage that process, and put together the pieces of the puzzle. But identifying, you know, if you want to buy something at 4 times EBIT, which maybe that's a dream to find today, but typically in private markets you can get much better valuations. A lot of those it's very obvious that you want to create the transaction, but the actual process of creating it is where the time is spent. So I think because of the cadence or the pace of what your daily life looks like in both of those, it typically pushes people in one direction or the other.
Yeah, I would completely agree. I mean, I haven't tried private myself, but when I think about all the sort of complexities, I would know very little about it, and yeah, I find it very appealing to only focus on public. You have certain sort of minimum standards. You can be a minority investor. You don't have to be an activist investor. Whilst saying that, I think what Rob said, to give input occasionally, that is a great thing, but you know, I find that very attractive and sufficient, and would see private probably as a distraction.
And I think you have to answer that question yourself. I don't know whether you can do both. If you can do both, I think it widens your competence, and that I would regard as positive. But whether it's too much for you or not, you have to judge. Maybe it's okay now, but it would be too much for you later on. But you know, I think it's much closer to being a businessman if you engage with private companies, and that there's some cross-fertilization. But maybe, as I said, you lose focus. But I think it very much depends on the individual. I mean, with Buffett, it has worked out fine, and but Buffett is not the norm, you know. But maybe you are the next Buffett. I don't know.
I just want to add a comment on this. Until 4 months ago, I was working in private equity, and there's a huge difference that is obvious between private and public equity. That is that in private equity, you either need to find the company yourself, or people have to go and sell it to you. So if you are investing a little bit in public equities, a little bit in private equity, and you do a little bit of everything and nothing really seriously, it's very difficult that you get off-market deals. So forget about this for EBIT, 4 times EBIT valuations. So you need a completely different setting to go on one way on the other. Completely different. And of course, Warren Buffett is the exception that we all know. We can also agree that he's a very special guy.
Great comment, thank you. Alexis.
Why do you think there's so few funds like Rob's?
First of all, most of the people who are in that industry grow up in a bank or in an asset management company, and that completely screws them up, most of them. And so I would say 95% are already lost before they even start. Now, and then I think it's essential to be alone, without analysts and without a team. It doesn't mean, sometimes you can have a partner, but it's another source of danger. But very few people dare to go out on their own. Then it's very difficult, especially nowadays, to find a vehicle that is cost effective and allows you to invest in a concentrated manner. It's almost impossible. He was lucky in that respect, and he even admitted it. And then I think even if the setup is right and the individual is okay, some people are just better than others, and you cannot really boil it down to anything that you can observe before. You know, there's many very reasonable people who are intelligent and passionate and have a sufficient setup, and some people make it and others don't. And it's something you cannot know in advance. You can push the odds in your favor, and you can say, okay, this guy has a fair shot at providing good returns, but whether he then will outperform by 3% or by 5 or by 10%, I think that's not knowable. And then to attract capital is super difficult. And I'm sure there's many people who could be as successful as Rob, but somehow don't get the capital. Not because they did something wrong, but just they weren't lucky enough, they didn't meet the right people, whatever.
Yeah, like a marathon winner in 19, whatever.
Yeah. So it's not, the world is not fair, and of course the ones that are successful always later on they say, oh yeah, and I was, you know, at the age of 5 I started reading about investments, and I was working 18 hours a day, and I was thinking hard about this and that, and usually these are lies. Comes down to a good portion of luck.
I'm not sure if I have anything to add on that one.
For me, Rob is a very independent thinker. He's an exceptionally independent person. I think he's a very, very strong communicator. And then on being corrupted by the institutional environment, I mean, I don't know that part of your life that well, but I think you were at a German bank for several years, and so I think it sort of could have happened there. So you certainly had the exposure, but I think it's more Rob's sort of pretty unique setup and personality for me.
Now the point of operational setup, you touched upon it several times. How important is the operational setup in your fund selection process? I mean, talking about specific fund vehicles, advisor versus sub-advisor, trading system, risk management systems, and so forth.
I'll throw out a couple of those last 2 points. And our general assumption is that if we find the right manager, we can figure out the operational piece. That's, I think, of all the different pieces of the puzzle that you're trying to solve for, that's the easiest one to solve for. So, do they have a big four auditor versus a second tier? I think that's something that you can figure out that's can be a distraction in terms of whether or not it's built. Whether it's not it's built to look like it's an institutional. It might actually tell you something from a negative standpoint, i.e., it's really built to raise money. And that's the sole purpose of the vehicle. But outside of that, if we find the right manager, I think the assumption is that we can typically figure it out. Though, other caveat I would add is that if people think about it, set it up in a way that makes sense and allows them to invest in the way that they think is most appropriate, there's a tell there. So it's not just the fact that it exists, but it's also that they have the courage and the fortitude to go and figure it out and to invest in the way that they wanted to invest, as opposed to investing in whatever way the market allowed them to invest. And then once that worked, then going and raising a different vehicle because someone else, say we came and said, hey, oh, we'll invest. And they said, okay, great, we'll create a new vehicle that matches whatever you want. I think there is a tell there, and it shows you why someone did what they did.
Yeah, I think it's very important because the setup doesn't lie. You know, letters and whatever somebody tells you, this is all words, but you don't really know whether there's any substance to it. But the setup somebody puts up is a fact, and I think it's very revealing, and I include the fee structure with it. And I have a strong preference for one-man shows, and I have a strong preference for no institutionalization whatsoever. That doesn't necessarily mean that if you have a little bit of institutionalization, you're not necessarily doomed to fail. But I think it's safer to look for one-man shows, because when I invest in something, I would like to stay invested for the next 30 or 40 years, ideally until I die. Because I'm lazy. Why would I want to sell something and then look for something else? And with Rob, I have confidence that in 20 years' time, he will be the same Rob, maybe less hair, maybe gray, but he will probably still sit in Kirchberg looking out his windows and reading annual reports. That gives me a lot of confidence. But if he had a partner, or worse yet, a team, you could be almost certain that in 20 years on, the situation will be completely different. And this is very unpredictable for me. I don't like that. I like things to stay as they are forever. And therefore, yes, I do think the setup is extremely important. And I'm sure there's many very capable people who have the wrong setup, and they will not make it, because I think the analogy is race car driving. If you are a perfect driver, but your car is slow, then forget it. And on the other hand, if your car is very fast, maybe you don't even need to be a first-class race car driver. So setup is really absolutely crucial and very revealing. Everything else is just blah blah blah.
Right. How do you distinguish between an evolution of manager, let's say when people move from buying cheap stocks to better quality to great cultures and so on and so forth, and how do you distinguish it from a style drift of people? Where's the line that you cut and say it's gone completely off? Not what I've invested with.
Well, again, it depends, and I don't necessarily invest in managers who have an explicit style or who call themselves value manager. I think that's they're not doing themselves a favor by calling themselves value manager or growth manager or whatever, you know. Either you're an investor or you're not, and price is always a crucial factor. You don't need to be a value investor to be. Look, everybody hopefully looks for price, and therefore style doesn't really happen in my managers, but character drift happens easily, you know, because if they are successful, you know, they have some serious lifestyle change. They start exchanging their wives. They become lazy and hire analysts. Sometimes they even either they raise their cap or they open another fund, and that fucks them up usually. And that is extremely important to watch. And the more people you have, or if you have a team, let's say of 4 or 5 people, you can be almost certain, you know, that at least one of them loses it. So it's much easier to have just one person to watch and watch him carefully and stay in close contact. And you can tell. I don't even talk about investments with Rob all that much. You know, we talk about cars and women and sports, and I will pick up when he starts to go crazy.
I'm not sure you've ever talked about women, maybe once.
No.
Thank you for that character assassination. Yeah, the fund will be reopening on Monday. The money's left. Yeah, you on.
I wanted to know more your view on the structure, knowing that you mentioned about the partners, because we already set up a fund with a partner, and we have been managing private portfolios for many years with a partner, and if you really want to look for really good investments, sometimes having a partner is a very good way to be able to enlarge your universe and learn more from each other and from each group of investors around them. You know, I fully believe one person, one subject tank is a very efficient way of investing, but even Rob has to create a network so they can exchange ideas, right? Or there are virtual networks like Value Investors Club even, and I don't see such a difficulty in a partnership. Or what is your view on that?
Yeah, I think it's probably the exception of the rule. Is if you look at, I mean, people can throw out, if you look at Buffett and Munger and say, you know, there's a partnership that's worked, but it's really not. It's really, that's the Buffett show. And Munger has been very humble and has had different types of interests, but at the end of the day, the person who's made this call is effectively Buffett. And so that's been our experience, that over time, actually I'll give a real example, but I won't name the name. So let's say I'm partners with someone else. We're both picking our stocks, expanding each other's research, pushing each other. And then we get to a period where I buy some stocks and they perform very poorly, and I hurt my partner. My partner's looking at me, and there's this inherent conflict because you're talking about emotional conflict, professional conflict, a potentially significant monetary conflict where the fund would have made, you know, X dollars of incentive fee, my partner would have made the piece of that, except that I directly cost them that money. And so I think during the time periods where there's significant emotional stress, whether it's inflicted by the market during an 08 type environment, or if it's inflicted directly by one partner or the other, it's very, very difficult for those structures to withstand the test of time in those moments.
But that assumes that both partners have quite a different mindset, or they see these things quite differently. It's not the mindset, right? And I'm talking about there can be some experience where the partner or the partners, or even if there is a small team, they have a clear mindset, they have clear goals, they know what they are looking for, and maybe they their work is more on ensuring that it's the right company for the fund they are managing. So, have you find this before? I hope.
I think it's incredibly rare.
Are you hoping to find another? You're hoping you're digging for another answer because you have a partner, and your partner may be very nice. He may be even nicer than you, but the fact remains it's a huge source of conflict down the road. And partnerships usually work when the business is mediocre. If it's unsuccessful, you get into a fight. If it's too successful, you also get into a fight, probably because about money. And then over time, individuals drift apart. That doesn't necessarily mean they become completely different people, but they, like in a marriage, over time, you know, it usually deteriorates and often fails. And that's the same thing with a business partnership. But I agree with you that an exchange of ideas is extremely important, but you don't need to have a partner, or worse yet, somebody on the payroll, especially nowadays with so many forums and the internet and everything, to have an exchange of ideas. And also in the beginning, it's quite cozy to have a partner. You know, it's like two kids being scared and walking through a dark wood. But at some point, the sun rises, and then you really don't need that other person anymore, and it becomes a burden. So there are situations where you cannot get rid of your partner, you know, for obvious reasons. And but if you ask me, what is preferable? Definitely no partner. Do it on your own, especially in investing, because you do not need somebody else.
I just had one comment, and Ron, I'll let you ask your question. But I think it's important to realize that asset management doesn't scale. If there was even the most minuscule economy of scale to investing management or through the research process, then it would be completely pointless for a one-man or even a 10-man show to try and compete with a Fidelity or a BlackRock or whatever, because they're so many thousands of times bigger that even if it was a 1% advantage, or a 0.1% advantage, it would be a very significant one. But as we all know, the larger the organizations get, there's actually quite big diseconomies. And I think there's some examples where two-man or partnerships maybe have worked, but I think the more people you add, the less likely it is to be successful. That's counterintuitive, but I think it's true. Ron?
Yeah, so there's a number of institutional constraints that have sort of become gospel among asset allocators. I'm thinking, just three that come off the top of my head are, you can't be more than 10% of your fund, or, well, interesting, come back when you have 100 million under management, or well, you have to have a COO, chief operating officer. This is more of a question for James, given you have a slightly more institutional setup. How do you interact with those constraints? What do you think about it?
So I think those are largely created to avoid career risk. So if I go and hire a manager that has a proven track record, they're 700 million, they have a risk officer, a COO, a CCO, all these different people. No, not in our organization, but I think generally if you fail in that situation, it's a more defensible way to fail. And so there's some element of protection there if you're sitting in our shoes, where like if we fail with a or if you put someone in business, it's a one person, if the obvious, with the benefit of hindsight, if something doesn't work, you can say, why did you back this person? They didn't come from a place with a great track record. They had a philosophy that was sort of a combination of a lot of different people. There was no institutional setup there to protect you against all these things. So I think the risk of failure often drives those. I'll come back to the 10% because I think there's a more nuanced answer to that, but I think generally that's what's going on. And so our group, and I think a lot of the best investors out there who are sitting in our chairs have made the decision that you're willing to take that risk in exchange for what you think will be better investment returns or a more likely destination. I think history would suggest that that actually is the outcome. It's incredibly difficult to achieve, but that's the ultimate goal. And I think there are a lot of different well-known investors that you can point towards that would suggest it actually is possible to do. On the 10%, I think there's a more logical reason for that. So if you think about numbers of a fund or percentage of a fund, if you're basically all of the fund, I think if you're over some amount, so say if you're 70% versus 80% versus 90%, the reality is that if you make the decision, you the investor make the decision to redeem, that fund will likely go out of business. So to me, there's not really much difference between where you are in that range. if you're on the low end, if it's 10% or 5% or 15%, it's largely not material because, again, if you think about worst case scenario, you make the decision to redeem or the manager wants you to redeem, it's much less disruptive to the business. I actually think the biggest risk is if you're somewhere in between. And so if you're, say, 40% of a manager and then the investor decide you want to redeem, you're inflicting significant pain on potentially on the portfolio, depending on how illiquid or liquid it is, as well as on the business itself. It can have a very dramatic effect. But the manager's probably going to stick around. They don't want to go out of business because they still have a viable business. So from my perspective, I think that's where you actually have the most risk in terms of the percentage of the fund that you can advise.
Yeah, I think I mean I'm much smaller than these guys over there, but it creates a barrier. If you give somebody so much money that he would die without you, and then in the beginning the returns are good, and usually they don't become terrible from one year to the next. They become a little bit less good, and then they are mediocre, and then you say, would I allocate now? And you would say no, but then you're trapped, and that's an uncomfortable situation, which I try to avoid. And I've been asked many times, because I usually bitch about the fees, and then very often I get the reaction, well, you know, we can build something for you and it will have your fee structure. And this is, for two reasons, this is a no-go. First of all, I want a different fee structure because a different fee structure changes behavior. But if I'm just a part of the business, and maybe a smaller part of the business, it doesn't change your behavior at all, because I get the same portfolio with a different fee structure. But it's not, I don't try to save much money. I just try to make sure that the incentive structure emphasizes performance and not anything else. And the second reason, if somebody builds a structure for me, then I find it from a human perspective very difficult to walk out, and I have to, even though it's not my goal, and I try to stubbornly sit with a manager for really very long, I have to reserve the freedom to walk out any day, and therefore you should not be a vital part of any fund, or sit in the structure that was just built for you. But of course, in the very beginning of somebody who doesn't have, who has no or very little assets like Rob, then yes, it's fine to be maybe a meaningful part of the business, because you anticipate, well, very soon you will be a small part of the business. That's fine. You have to take that.
Okay, so it's about 5 to 12, so maybe the last question now, or maybe...
Back to structure, but actually more the legal aspect. So where do you see the structure of the fund structure in the future and the alternatives? So my feeling is that it has become ever more complicated and costly to actually set up a structure and maintain it. So going back to the chicken and egg problem at the beginning. So for example, also then requirements for companies to manage collective investments. So like in Switzerland, they don't want one-man-ships to run funds anymore and things like that. Where do you see alternatives to it, and where do you see that going?
I don't really know, but I guess you can still set up a BVI or a Cayman structure. It costs something, but it's relatively cheap. And maybe there's some other jurisdiction where it's relatively, I really don't know. But I agree with you, it's become much more difficult, and the regulators, they know shit about these things. I mean, it's a scandal that you cannot set up a one-man fund in Switzerland anymore. I mean, it's totally ridiculous. And I really don't know, but I would think BVI in Cayman is fine. Of course, many people say, yeah, but you know, if you want to sue the manager, then it's very difficult in Cayman or BVI. Yes, I agree. But you should not invest in anybody on the assumption that you might have to be in a legal dispute. You know? So, to me, it's perfectly investable.
Do you want to add anything to that? Or? Okay, so time for one last question then. You have a look. Did you have you asked one yet? Or?
Not
Okay,
yet.
then I'll give it to you.
I did yesterday.
Okay.
I just wanted to ask on one particular issue which you see a lot in hedge funds, which is the manager co-investing in the vehicle. Is that something you regard as prerequisite, dangerous? How do you see about that? I wondered if, for example, if they have too much of their personal wealth in the fund themselves, they don't have enough risk tolerance, for example.
I think part of it depends on, if you go back to the beginning, why the vehicle was created. So if the vehicle was created, I think there's largely two reasons why they're created. One is because running a hedge fund is a great compensation scheme. And so if it's built for that reason, then the structure often wasn't built because it's the best way to compound wealth with the highest rate over time. So if that's the case, then I think, yes, if you have a significant amount of your personal wealth, you the manager invested in the vehicle, you can actually end up with pretty perverse incentives where the managers incentivized because of the fees just to stay in business as opposed to generate great returns. Those are largely vehicles that we try and avoid. If the investment set up where the manager built the vehicle really to compound their own personal wealth and they think their particular strategy is the best way to do so, sort of have less of a strong view around it. But if someone wanted to, if they had a lot of their money and wanted to take some out, don't have a strong view one way or the other on it.
I think usually it's a good sign if somebody has a meaningful part of his wealth in the fund, usually, but I don't insist that he has everything in the fund. I would even say that it's mildly stupid if you have, especially if the fund is big, if you have 100% in your own fund. I mean, I think that's really, it depends, but if somebody tells me, well, I only have 50% in the fund and the rest I have or something, that's perfectly okay. But if a manager starts out and he tells me he has only 10% of his own money in the fund, then that raises some questions. But again, it depends on the context and
maybe the strategy too.
And very often you don't know. I mean, you get an answer, but it's very difficult to verify whether that answer is true. Very often you get the answer, yes, I have money in my own fund, but then of course, yeah, how much money? Yeah, I have, I don't know, 1 million, but that doesn't tell you anything. And then of course I have to ask you, well, what percentage does that million constitute? And then sometimes you don't get an answer anymore. So the percentage needs to be meaningful, but I don't think it needs to be, or it even should be 100%.
Does it maybe you see much more fund managers than I do? Is it maybe the case that it's almost become table stakes to have a significant investment in your own fund, so that kind of loses any signal character it has? Or
Of course, I think so.
Yeah. Okay, difficult to believe, but it's 12 o'clock, which means it's finished for another year. But, thank you everyone for coming, and yeah, hope to see some of you next year.